This is chapter 24, where we're going to talk about standard cost systems. The U.S. government, particularly the military, spends a lot of money on stuff, so tanks, helicopters, pistols, rifles, etc. And to help the Army and other branches of the armed service with the procurement of tanks, aircraft, missiles, communication satellites, and other things, the Office of Management and Budget operates the Cost Accounting Standards Board. As you can imagine, as many of these contracts are made, they are often cost and cost plus. They just have to carefully manage what the costs are and know what they're paying for to get exactly what they want. So there's a 5-member Cost Accounting Standards Board. It's independent, legislatively established board. They establish standards, and these standards help with the estimation, accumulation, and reporting costs in connection with prices for all procurements to the U.S. military and other contractors in excess of $500,000. So they've got to follow these rules associated with cost accounting. An important part of cost accounting is a measure of standard cost. These are the costs expected to be incurred under normal or operating conditions. So standard costs are estimated separately for direct materials, direct labor, and overhead for each of the things that are produced. So it's the comparison of actual to standard that is really the critical component to see where things are different than expectations. And this is key to diagnostic analytics as we talk about it. It's finding the differences and then trying to explain why that might be. As we talk about variances is the difference between actual and standard costs or actual and standard quantities. We say a variance is favorable if actual costs or quantities are less than standard, and unfavorable if they exceed the standard. So let's look at some examples of this. First of all, you'll see here's the actual column here in the blue, and you can see we have direct materials that tracks actual quantity and cost. We have direct labor that tracks actual quantity cost of labor, and overhead that tracks overhead costs. And you can see what those look like, and you can see when this is combined with a variance, that is diagnostic analytics. Essentially, we're saying actual is different from standard, and the difference between the two is a variance. Now, it's interesting that the standard cost is what's charged to, first of all, to work in process, and then from work in process to finished goods goes both the standard costs as well as the variances. This allows accountants to track and control costs to bring these to management attention. So who establishes these standards? Well, they're going to be made up by management. Under ideal conditions, management would leave no room for any inefficiencies. Well, inefficiencies happen. They can't always be ideal, and so we're trying to figure out some level, since ideal expectations are unrealistic, trying to get some level of expectation that is less than ideal. And so that's what we're trying to figure out here. So first of all, talking about the direct materials standard. First step in establishing standard costs is identifying the specific materials that need to be used, and then determining the cost of the material, and then determining the quantity of material that should be used. So here's a good example that most students and I am interested in, right? That would be pizza. Maybe not frozen pizza, but pizza, right? If the standard quantity of cheese allowed per pizza is 1/4 pound, and the cost of mozzarella is $2.40 per pound, the standard cost of cheese per pizza is 60 cents. That's $2.40 a pound times 1/4 pound. Okay, so the setting of direct material standards also involves assessing relationships among cost, quality, and selling prices. Okay, so high quality materials cost more, but there might be less waste, less spoilage, fewer product defects. So there's reasons to use high quality materials. It's not just all about cost, it's overall costs, right? But that should be built into our standards of what we want. So the cost and quality used in productions are key factors in determining selling prices. If we have higher quality goods with higher quality components, we can probably have higher selling prices. We also need to consider costs such as storage, availability, waste disposal, and shipping. While those might not be part of our manufacturing, these are going to be important components in determining sales price. So that would be for direct materials. Now, how about direct labor? Okay, so we want to establish standards for direct labor. We need to know the expected wage rate and how much time it takes to produce each product. So this is going to be according to time spent. So assume a standard wage rate for production worker is $15 per hour, and the standard number of hours allowed for a particular table is 3 hours. So that says the standard direct labor cost for a table would be $15 times 3 direct labor hours, or $45. All right, so how do you set these standards? Well, you're going to have engineers, you're going to have union representatives, cost accountants, factory employees, all giving input on what should be reasonable. And so we want these to be really reasonable standards so that we can compare to actual and not just blame it on, hey, the standard was unrealistic to start. Well, then it doesn't really make as much sense to compare actual to standard. So automobile companies, several automobiles let manufacturing workers take part in establishing their own standards. The idea is they're there doing it all the time. While managers, industrial engineers set standards, hey, we want to give them targets that are reachable. Kind of the behavioral approach there. Once we talk about direct labor and direct materials, we want to spend a minute talking about manufacturing overhead. We want the standard overhead cost per unit to be estimated at the normal level of production. So various cost drivers, activity-based costing, are often used to develop the standard, and then it's going to be applied. We're going to have this applied overhead rate that we're going to use. So to illustrate the use of standard costs, we're going to examine the operations of Bryce Mills in Moscow, Idaho. The company's major projects are laminated wooden beams used in the construction industry. Has 2 steps. First, 2-inch by 12-inch boards of varying lengths are cut from rough white pine lumber, and then they are glued together. Okay, so there are 2 parts of this process. So we have production and materials. Bryce manufactures a beam which is 20 feet long and requires 6 layers of pine boards. Okay, so if you remember from the last slide, it essentially said, hey, there's 2 parts, right? It's cut and then glue. All right, and so we have those 2 component parts. So due to inherent defects and waste of materials, the company allows 264 board feet as a standard quantity for each 20-foot beam. Okay, so remember the 20-foot beam requires 6 layers of pine boards. Okay, the standard cost of rough pine is 25 cents per board foot. The standard cost of direct materials for the beam is $66. That's 264 feet. That's the standard quantity times 25 cents per foot. Okay, so that establishes the standard cost associated with materials. Next, direct labor. How many hours does this take? Bryce has established a standard of 1.5 direct labor hours for each beam, and the standard labor rate is $12 per hour. So if you take the 1.5 times the 12, the direct labor cost for each beam is expected to be $18. There's a third component, which is manufacturing overhead costs. All right, and as we've talked throughout this text, there are supervisor salaries, depreciation on equipment, property taxes, repairs, electricity, and direct materials. Whereas this top set is fixed, this bottom set is variable. So we'll want to think about that. So price budget is total. Notice this is the fixed overhead related to the production of beams at $5,600 per month. At the normal production, we're producing 700 beams, and so that would be $8 per beam in fixed overhead. In addition, the company applies variable manufacturing overhead to beams using direct labor hours as an activity base. Okay, this application rate is $4 per direct labor hour. So if each beam takes 1.5 hours, we can expect to charge or incur $6 per beam. This $8 plus this $6 gives us a standard cost of overhead of $14 per unit. So we're going to come up with what we often call a standard cost card. It probably isn't ever on a card anymore, but here are the standard costs. Direct materials, $66. Direct labor, $18 per beam per unit. And then the fixed and the variable component all add up to $98. And this just summarizes what we've just come up with. All right, that's the standard cost. That's kind of what we expect. But then actual comes along, and says, hey, as a result of delays, only 600 beams were produced instead of the 100 we expected. Okay, there were no units in process at the beginning or at the end. The total manufacturing cost for 600 beams was $58,720. Okay, and so so we're going to look at these actuals and compare that to the standard costs. And so we see here, comparing actual to the standard cost, the total actual was $58,720, and the standard cost allowed for producing 600 units. Going back is $98 a piece, right? Here. And so we see a difference here of $80. This is for everything, right? This is for materials, labor, and overhead. So let's see why that is. Okay, relationships among labor and materials. Okay, rough pine labor gives us the lumber price. The better the wood, perhaps less knots, less warps, less cracks, less blade cuts. And here is what we're expecting. So we complete that, we cut the beams, and then we have glued boards. So you can see how they work together between the materials and labor variances. Okay, so let's go ahead and start to compute these. In establishing the standard cost for each unit, when we were looking at price, we looked at the quantity of materials required, how many materials did we use, and the price that should be paid to acquire these materials. So why is there a variance? Well, it's a difference in the quantities used, a difference in the prices paid to suppliers, or a combination of these factors. So let's look and see how we did in terms of a materials variance. To create 600 laminated beams, we thought it would take 158,400 board feet, and the standard cost was 25 cents per board foot, costing 39,600. But we actually spent 180,000 at 20 cents per board foot, so it only cost us 3,600. So we had a favorable cost variance of 3,600. So let's see why that is. Okay, first of all, let's compare. We spent 180,000 board feet, but instead of paying 25 cents, we spent 20 cents. So the materials price variance was 9,000 favorable. So for the material quantity variance, we're interested in how much labor we used, how much lumber we used, and how much more or less it was than the standard. And it says that we used 180,000 board feet when we were expected to use 158,400 board feet. And so we're going to evaluate that and find that variance to be 5,400, unfavorable. And so as it comes to summarize what has happened with the materials variance, we go and look and see these. And so we're going to charge standard cost to the work in process inventory, and we're going to see that standard cost, but then we're going to see some charges to the quantity variance, which was unfavorable. I think of it like an expense or a debit. I think about materials price variance, which was favorable because we got 20 cents instead of 25 cents. Perhaps we got low quality materials, and that meant we had to spend more on materials. And so maybe that makes sense. Maybe in the future we need to change that variance. Okay, so let's go ahead and go forward here. The labor rate and efficiency variance. So we now look at the labor. What was the rate? What was the wage rate we actually paid, and how efficient were they? How many hours did they take in each case? And so they actually incurred $14,040 in March. The standard labor cost allowed for manufacturing beams is only $10,800, so we spent more than we expected to. Thus, the company has an unfavorable variance of $32.40. We spent more than we expected, and now we're going to try to explain why. It's either the rate variance, or on the next slide we're going to evaluate the efficiency variance. But we can see that. So the actual labor hours we spent was 1,080, and we expected to pay $12, and we actually paid $13. Okay, so we saw how much that was. That was the 1,080 unfavorable. And then we see the labor efficiency variance. We expected to use 900 hours, and we spent 1,080 hours, creating another variance of 2,160 unfavorable. And so you can see what that looks like here, and we can say both it was more expensive, higher wage rate, as well as less efficient. And so we can look at that. So if we're looking at our kind of where we're at here, here's how much the actual cost was. Here's the two unfavorable variances. I think about them as a debit or additional charges or additional expenses that went to work in process inventory. And so you can see it went into work in process at standard cost, but then we're going to track separately our rate and efficiency variances there. The next thing we want to look at is the third component, which is manufacturing overhead. And these have two components, and they're the spending variance and the volume variance. Okay, the volume variance occurs because we may have produced more and applied more overhead, or used less overhead or applied less than we expected. The more interesting of the two and the more controllable of the two is the overhead spending variance. And so you can see, what the case is here. We expected to spend $9,200 in our standard overhead cost, but we actually spent $8,680. And so we see that as an overhead spending variance. We spent less than we expected to spend on that. Now notice we're using the 600 units of production, even though we budgeted originally for 700, but we actually made 600. And that it gives us rise. That's the reason that we have an unfavorable volume variance. It's not something we can necessarily control as far as overhead goes, but it says, that's how much we planned, and was 700, but we actually did 600, leading to an unfavorable volume variance. So this just kind of says that again, the volume variances occur automatically and will always happen when the actual output is different than the standard. And so we see that that's not something we can control, not necessarily efficient or inefficient. That just says how many we made. And that's not, in some sense, the fault of our overhead variance. So to summarize, we see this unfavorable variance here for overhead volume. We see our overhead spending variance, which was favorable, all to explain why there's a difference between the two. And so when it's time to look at the valuation of finished goods, what goes into finished goods is the amount that is in work in process. So here reflects how much we transferred from work in process inventory to finished goods inventory during the March period, reflecting the completion of 600 beams. All right, so a little bit more here. The balance and the variance account are typically allowed to accumulate from month to month, but then at the end of the period, we're going to close those out to cost of goods sold. Okay, and we'll charge that to this period. However, if the balance and the variance account represent a material amount, we're going to do it immediately and charge it to both work in process as well as finished goods, as well as cost of goods sold. So it kind of depends on how big they are, how material they are in general. So we can kind of see what that looks like. All right, so looking at a different perspective, Bryce's cost accountant prepared cost variance summary reports, and among those attending the meeting is the director of purchasing. Okay, what was the cost of the materials? The production manager, essentially saying, how efficient are we? The quality control inspector, did it require rework? Employee grievance representative, essentially saying, hey, were the standards too high? Did we use too many? And looking at those perspectives. And with that, we can give them a variance summary report, see how we did in each of the areas: favorable variance for materials variance, unfavorable for labor, and unfavorable for our overhead variance. So we can kind of see why that was different than cost. Okay, so cost counter opened the meeting by saying, hey, we have good news. We had total manufacturing variance $80, so not much, but favorable for the first time in many months. Especially pleased about the successful effort to control manufacturing overhead costs, as revealed by the 520 favorable overhead variance. So that's good news. It was less than we expected. The bad news is that several unfavorable variances occurred during the month, and it may have been, all of these unfavorable variances, both unfavorable labor rate, unfavorable labor efficiency, unfavorable materials quantity variance, and perhaps it was the extent of rework that it would be required. So, as they're going through the meeting, the first person to respond was the purchasing agent. He stressed that none of the unfavorable variants experienced were under his control. He only managed the price variance, so he supposedly saved the company from disaster. He pounded the table saying he shopped for the best pricing at the best bargain. Okay, but now the other is we're saying you might have gotten a good price, but these were grossly inferior quality, and that required us to use more materials and to spend more time working through these production bottlenecks because they were less than we expected. The quality control concurred with the production manager saying these didn't pass inspection, and since they didn't pass inspection, or if they did so only marginally, that isn't good news either. That means it took more time. So then we go to the grievance representative representing the factory workers and saying, hey, low factory morale, productivity is way down, and one of the many reasons was due to inferior materials, and so that might have been the reason. Okay. Concluded saying, hey, the only good thing about this is we had more work based on these materials, so we got overtime pay, but overtime pay is expensive, great for the workers to get, I guess, but expensive. Now, from a marketing perspective, the sales manager says even with overtime and extra shifts, our demand still exceeded output, so that's good. He told the company's cost accountant this was one of those occasions when an unfavorable volume variance had severe implications. So what does that mean? We were trying to sell 700, but we only made 600. And so will we have enough in the future, and will they be of sufficient quality? So as the overall plant manager, we say, hey, we have a bonus system based on variances, but what does that mean? It looks like the production manager might have got a favorable variance, but the low quality of the material coming in required unfavorable variances in the other areas. So we can see why that is. Now, a just-in-time approach combined with total quality management can often reduce or eliminate many of these unfavorable cost variances. So we could find this material usage quickly, and we could say, okay, since we got another delivery tomorrow, let's stop the production process and let's make sure we're getting sufficient quality materials and sufficient production quality as we go. So in summary, this shows all of the variances that we're going to show and completes this chapter.